Think about a pair of shoes, not just any shoes. These particular shoes were photographed on the feet of Barack Obama. They appeared in profiles of Elon Musk, of Tim Cook, of every other tech founder who wanted to signal that they were successful but did not take themselves too seriously. They were made from merino wool, certifiably sustainable, and they came in colors with names like Natural White and Blizzard. They were called Allbirds, and in Harvard, the company that made them was valued at $4 billion. Now think about what $4 billion buys you. It used to buy you Allbirds. Today, it buys the company that just announced it is abandoning shoes entirely and pivoting to renting GPU servers to artificial intelligence startups. A company that sold its own brand name 2 months ago for $39 million. A company whose stock spent most of this year trading below $2.50. On April 7th, that company's stock ticker bird closed the trading day at $16.99. That is a 582% single-day gain. Intraday, it touched $24.31. Nearly 876% from the previous close. Across the full session, approximately 275 million shares changed hands. In a typical week before this announcement, the stock would trade roughly 111,000 shares per day. That means Tuesday's volume was, by some calculations, 875 times the average daily trading. The stock was halted for volatility multiple times during the session. I want you to sit with that for a moment before we go any further. Because what happened on Tuesday is not really a story about artificial intelligence, or about GPU servers, or even about one particular company that ran out of runway in the sneaker business. It is a story about a very old and very specific pattern in the history of capital markets. And that pattern has a name. Allbirds was founded in Havni by two people whose backgrounds should be on the record if we are going to tell this story properly. Tim Brown is a former professional soccer player from Wellington, New Zealand. He played internationally, including serving as vice-captain for the All Whites at the FIFA World Cup. His idea for Allbirds came from his frustration with synthetic athletic footwear and his familiarity with New Zealand's merino wool industry. He is not an engineer, not a technologist, not a product designer in any formal sense. Joey Zwillinger holds a degree in industrial engineering and an MBA from the Wharton School. He previously worked at a biotech company focused on algae-based fuels called Solazyme. He is the technical co-founder. He is also not a cloud computing executive, an AI researcher, or a data center operator. Those two people built something genuinely interesting, a brand that found a real cultural moment, a shoe that sold an idea as much as it sold footwear. In the fall of TV Dead, they took it public on the NASDAQ at $15 per share, valuing the company at close to $4 billion. What the IPO prospectus could not change was the economics of the business. Allbirds was growing, but it was burning cash that the revenue could not replace. They expanded into apparel. They opened more stores. They chased the logic that being a public company requires perpetual growth in ways that eroded the clarity of what had made the brand feel meaningful. Competition from On Running and Hoka, brands that offered performance alongside aesthetics, began drawing away exactly the consumers Allbirds had cultivated. By Thuvade, the stock was down 70% from the IPO price. By Ferdi, down 90%. By early Fundy, 20 capitalization had fallen to roughly $22 million. That is not a typo. $22 million from $4 billion. In March of this year, they announced the sale of the Allbirds brand name, its intellectual property, its shoe designs, and its trademarks to a company called the American Exchange Group for $39 million. The company announced it would distribute a special dividend to shareholders and wind down operations. Almost everyone assumed that was the closing chapter. They were wrong. On April 7th, the shell of the company that had already sold its core business issued a press release announcing a $50 million convertible financing facility from an unnamed institutional investor. The plan was to use that money to purchase high-performance GPU servers and rent the computing power to AI companies and enterprises. The business model would be called GPUaaS a service. The company announced it would be rebranding to NewBird AI, pending a shareholder vote scheduled for May 7th. Before we analyze the business case, I need to address what happened in the market that afternoon. Because the 275 million shares that traded are not all the same story. The first wave of buying came from what analysts now openly classify as meme stock mechanics. The company had a very small float, a large short position from traders who had bet on the stock, continuing its decline, and a news catalyst that attached the company to the most incandescent word in finance right now. When the press release went out, retail momentum traders found the stock. That initial surge triggered the short sellers who were forced to buy back shares to limit their losses, which drove the price higher still. High-frequency trading algorithms amplified every upward tick by reacting faster than any human could. Each trading halt reset the pressure and released it again when trading resumed. This is the anatomy of a meme stock event. It is not driven by anyone's belief in the GPU as a service thesis. It is driven by a low float, a short squeeze, algorithmic feedback loops, and 15,000 strangers on financial social media, all moving in the same direction at the same moment. And the structural engine underneath all of it is something that financial historians have documented across 3 different market bubbles. It is called the name change premium. In I3 academics named Michael Cooper, Orlin Dimitrov, and Raghavendra Rao published a paper in the Journal of Finance. The title was "A Rose Calm by Any Other Name." They had tracked every company that added an internet-related term to its name during the late GPUaaS.com.net. Internet, any variation. The finding was that these companies experienced average abnormal stock returns of 74% in the 10 trading days surrounding the announcement. 74%. Not because anything changed in the business, because the name changed. The study also found something particularly striking. The companies with the least actual connection to the internet, the ones where the pivot was most obviously performative, often saw the largest initial gains. The market was not evaluating substance, it was evaluating signal. The dot-com bubble collapsed. Most of those companies are gone. Then, in December, sous vide at the absolute apex of cryptocurrency mania, a microcap beverage company called Long Island Iced Tea Corporation announced it was pivoting to blockchain technology. They changed their name to Long Blockchain Corp. The company had no blockchain products, no blockchain partnerships, and no meaningful plan to enter the industry. They had a name. The stock rose more than 400% before the market opened the following morning. The sequel was precise and predictable. The company never executed a blockchain strategy. They were delisted from the Nasdaq in 20. In IT, the SEC charged 3 insiders with securities, fraud, and insider trading, alleging they had tipped off associates before the name change went public. One of those associates bought 35,000 shares and sold them within 2 hours of the announcement, generating roughly $160,000 in what the SEC called illicit profits. The SEC revoked the company's securities registration in full.com. Blockchain AI, 3 different decades, 3 different magic words, 1 identical sequence of events. Now let me be honest about the business. NewBird AI is actually proposing, because the GPU infrastructure market deserves serious analysis. The demand for AI compute is real. CoreWeave, the largest independent GPU cloud provider, raised $11 billion in a Thunderway IPO on the strength of that demand. Amazon, Microsoft, and Google have collectively committed hundreds of billions to AI infrastructure build-out. This is a genuine industry with genuine revenue and genuine growth. But here is the mathematics that the press release does not invite you to perform. An NVIDIA HIG GPU, the current standard for serious AI training workloads, costs between $25,000 and $40,000 per unit, depending on configuration and supply channel. After accounting for server chassis, networking switches, power infrastructure, cooling systems, data center space, and the engineers needed to run the operation, $50 million gets you somewhere between several hundred and perhaps 1,500 GPUs in a production-ready environment. CoreWeave operates clusters counted in the tens of thousands of GPUs. Microsoft and Google operate data centers measured in hundreds of thousands of accelerators. NVIDIA shipped hundreds of thousands of these chips last year alone. There is also the matter of the financing structure itself. The $50 million is not a stock offering. It is a convertible note, meaning it is debt that can, under terms set at the May 7th shareholder vote, be converted into new equity. If that conversion happens at a price below current market levels, which is common in these structures, existing shareholders will see their ownership percentage diluted substantially. The company has not disclosed the conversion price. That detail is buried somewhere in the proxy materials. A former shoe brand, run by a New Zealand soccer player and a renewables engineer, with $22 million in market capitalization 2 weeks ago, is now planning to compete in AI infrastructure against Amazon, Microsoft, Google, and CoreWeave. With $50 million of convertible debt and no disclosed customers, the market gave them one extraordinary afternoon. The day after the announcement, the stock fell 36%. I want to be careful about one thing here, because intellectual honesty requires it. The history is not unanimous. There are companies that have survived improbable pivots. Amazon was a bookstore. Netflix mailed DVDs. The label doomed pivot has been attached to companies that later became defining institutions. Markets do occasionally get things wrong in the skeptic's direction, as well as the believer's direction. But the structural pattern here is severe. No operational AI infrastructure, no disclosed customers, no team with cloud computing expertise. A financing structure that may significantly dilute the very shareholders who drove Tuesday's rally, and a shareholder vote in May that will determine terms nobody has seen yet. The last company that announced a name change vote like this one saw the SEC arrive at its offices less than 4 years later. Here's the question I want to leave you with. I do not think NewBird AI is the story today. I think the story is what Tuesday's trading volume reveals about the baseline level of speculative hunger in this market right now. 275 million shares of a company that had been trading at essentially zero interest, 875 times the average daily volume. Multiple circuit breakers tripped mid-session. That level of energy does not appear from nowhere. It is a signal about the temperature of the AI investment environment broadly. And the question worth sitting with is this: if a company that already sold its own brand name for $39 million can trigger a 582% surge by announcing GPU rentals, what does that tell us about how the rest of the AI infrastructure market is being priced right now? Is the heat we are seeing in AI infrastructure a rational response to a generational technological shift? Or is it the same psychology that turned Long Island iced tea into Long Blockchain Corp, running on faster algorithms and a bigger audience? Drop your answer in the comments, because that question is not rhetorical, and the answer matters for a lot more than one stock ticker.